Welcome back. You're still tuned into Trading Hour. IndiQube Spaces is the first management joining us on the show. The company's Q3 revenue surged while the EBITDA rose 32% during the quarter. Rishi Das, co-founder of IndiQube Spaces, joins us now. Rishi, good morning. Thank you so much for joining in. It's been a good quarter. You do have assets under management close to 10 million square feet as on Q3. Now, give us an outlook for FY27 because we're almost done with FY26, right? What kind of AUM growth are you targeting? What kind of seat addition would you see? And FY26, will you be ending with the growth that you saw in 9 months, which has come in at 37% revenue growth? EBITDA is up almost 80%.
So thank you so much for giving us the opportunity to talk on this. And we are very confident that whatever we have achieved in the 9-month period, I think when we close the year, we should be pretty much on similar numbers. And as you talked about the guidance for the next year, I must highlight that as of now, if you look at our total area that we have, which is occupied, is about 6.3 to 6.5 million square feet. And our total AUM is about 9.5 million. So we have a headroom of almost 3.2 million square feet, which will get leased out pretty much over this quarter or the next year. So we have a lot of headroom for growth, and we are very hopeful that we should be north of 30% growth in FY27 as well.
To say headroom.
30% growth for FY27. Rishi, hi, this is Ritu. Your area under management, your center seats, they've all grown by about 19%, over the previous year. Occupancy has also improved to more than 80%. But as you expand, you add more cities and more centers, how will you ensure that this occupancy level doesn't get diluted? I mean, so to speak, what is the red line between growth and utilization?
So we are very focused on the occupancy along with the growth, and at the same time we maintain a good headroom for growth. So our philosophy has been that when we look at the entire country, we have classified the whole country into different micro markets. So there are about close to 50 micro markets which we believe are good performing micro markets. And when I say good performing micro markets, their occupancy levels in these micro markets are between 85 to 95%. So these are the good micro markets which we continuously track, and we look at basically deepening our presence in those micro markets to a newer supply additions. And if we choose our markets well, I think that is the first and the most important thing. And then we look at other factors like proximity to metro stations, the location advantage, picking up full buildings most of the time, unless until they happen to be grade A tech park kind of spaces, so that the assets needs to have a lot of defensibility in terms of its quality as well as in terms of its location. And then the last but most important is the quality of services. So as a result of that, our retention of clients has been very, very high. Okay. And that has ensured that occupancy levels are continuously high.
So around 84%, that's the occupancy. Yes. How much of it has come in from mature centers? What is the occupancy for new centers? How long before you break even? And just coming back to my first point, you said you'll be able to maintain the 9-month growth in FY27 as well, right?
Yes, that's true. And we have the classification that centers which are more than 12 months old, we classify them as steady state centers. And our occupancy in steady state centers is about 91%. At an overall portfolio level, we are at 84%. And if you look at less than 12 months centers, which is the other classification, will be about 81, 82%. So that's the broad mix. Plus, from the time we start paying rent to our landlords for any property, we typically take 5 to 6 months to reach 50 to 60% occupancy. And that is our operational break-even. And in less than 12 months, we are able to reach 90% plus occupancy in most of our steady state centers.
So to assume within 5 months you achieve break even in these new centers, yeah. But Rishi, your net debt has become quite low. You also have some capital you're sitting on. Where would you be deploying that? I mean, are you looking at more expansion? What are the areas you're looking to enter, say, in the next 1 or 2 years? And what will be the highest drivers of growth? I mean, is it the top metro cities, the emerging markets? Give us a breakup of that.
Yeah, so basically, like as you are aware, we last year raised about 650 crores of capital. And a large part of that capital is already available with us. We used a part of it to repay our debt. And that is where you see our debt is extremely low over there. And the bulk of the money that we raised is going towards the capital expenditure for our expansion into fit outs and other stuff. And our lot of growth, I must say, in terms of area at least, is going to be in tier 1 cities. typically Bangalore, or look at other Mumbai, or for that matter, even NCR, Hyderabad, Chennai, all these major metros. And we will continue to grow into the tier 2 cities. Like, for example, if you see in the last year, we have added 3 new cities. And the last quarter, Q3, we added Bhubaneswar. So we see that city addition will continue to happen, even though the tier 2 cities are small in terms of their footprint. But yes, we see a lot of promising growth. So bulk of our growth in area will come from tier 1s, with a lot of footprint expansion in tier 2.
Okay. Rishi, you mentioned that you have an AUM of 9.5 million square feet, out of which around 6.5 you're able to use. So there's some leeway for growth. So does that mean you'll not do more addition in your assets under management until you reach a level of utilization, or you will continue to add and that will get added by seat additions as well?
Yeah. So absolutely right. So AUM will continue to get added. If you look at, like, we have been adding 1.5 to 2 million every year. And we see that FY27 will be no different from that. And we have a good pipeline. And a lot of buildings which we take up, we mostly go when the buildings are getting constructed at the greenfield stage or under construction building. So as a result of that, we have a 12 to 18-month lag from the time any asset is signed up and by the time we occupy that asset. So the point I was highlighting was that this 3.2 million that we have immediately available, which will now start becoming available, large part of it in FY27. So that gives you an idea that from 6.3, if I have to go to 9.5 and I have to manage an occupancy level of 85% odd, there is a lot of growth that we are looking at happening due to this AUM. Plus AUM addition will continue to happen.
Okay. All right, Rishi, it was a pleasure speaking with you. Thank you so much for joining in today with your thoughts and the outlook on the business going forward. That's the word coming in from IndiQube. They expect the growth to continue, and this will be driven by additions across micro markets, be it tier 2 cities, but majority growth will come in from the tier 1 cities. Slip into a short break. When we come back, we'll discuss market fundamentals with Shiv Diwan, MD and head of Nuvama Institutional Equities, from the sidelines of the 21st Nuvama India Conference.